Hi everyone, this is Rohit from Rice and Montreal, and today I'm excited to have Michael Cardamone, who's the founder of Forum Ventures, a leading seed stage SaaS venture VC firm. Michael has done his MBA from Columbia Business School. Thanks to Sandy Corey from the Horizon Venture Capital for the introduction. Welcome to the show, Michael.
Thanks for having me. I appreciate it.
Awesome. You've been a part of some great startups. I just wanted to understand, how did you get into this crazy world of startups?
Yeah, I was working for a family business, which worked with a lot of very kind of mom and pop small businesses, and uh, prior to business school, and just wanted to do something that was kind of could be at a bigger scale. And I went to business school and met people in the tech world and venture and startups, and just got obsessed with getting into tech, and decided after business school I was going to move out to San Francisco and try to break into tech, and ended up interviewing at startups and mid-sized companies and big companies, and ended up landing at Box when it was about 25 people. Mostly not because I had some amazing foresight that they were going to be a big company someday. I had no idea how to evaluate that at the time, but it was more they were giving me more responsibility than I probably deserved, just given it was a startup and they needed help with a lot of different things, and so it felt like I was going to be able to have a bigger impact sooner and learn a lot. And it was a fun kind of culture and time to be in the company, and so made the decision based on that. And so I ended up joining that in 2008, and then have been in tech ever since.
Got it. And you've been into sales and partnerships, and so have I. I focus a lot of time on business development partnerships for listeners. Who are building a career. What are some of the KPIs a partnership guy or somebody a BD guy should really look at? And what did you really look at Box?
Yeah, so at Box when I joined, they were still primarily focused on consumer acquisition and trying to get kind of consumers in, and the freemium model, and they were just at the early stages of kind of transitioning to B2B. And so a lot of the partnership stuff was just figuring out, like, how do you get more, either distribution into B2B, how do you drive more leads for the sales team, how do you like build credibility in certain industries, and so I think the first and foremost in BD can mean a lot of different things to a lot of companies, and I think a lot of it is just getting aligned with the leadership team and the sales org on what are the goals of the BD team, because they could be very sales driven, where you have like quotas and top of funnel like SQL type quotas around it, or it could be more around building like brand credibility in certain industries, so that maybe your close rate gets better in those industries. So as an example, we did a deal with like the American Bar Association to try to build more credibility in the legal vertical, so that we had an easier time selling into law firms, because we had some early traction there and wanted to get more. And so they were, in theory, they could have been like a distribution partner, but it was mostly about like the credibility of having the stamp of approval of the American Bar Association. So it's most aligned on like what are the goals of BD, of the BD function, and then kind of setting KPIs around those goals, and that can be different for every company.
Got it. Interesting. You mentioned about the freemium model, and I recently had Rob Walling, who used to run Drip earlier, and he mentioned like freemium model could most people should not run a freemium model unless they're a B2C product. But what are your thoughts on that? For B2B SaaS companies, should they have a freemium model?
Yeah, I mean, so like when it was a long time ago, and Box still has it. I think they still have it now. And there's been a lot of successful companies built on the freemium model. I think it's hard to say you should or shouldn't. Again, I think it kind of depends on the product and who's ultimately buying it and using the product. And I think there are some cases where it makes sense to do a freemium model if you need to get that like groundswell of end users to then help sell into whoever the decision maker is on a larger contract. And if getting them if it's easier on a free version of the product to get them in, then I think that can make sense. I think the key is then figuring out like what are the triggers within your product and how your users are using your product to then start charging. And I think that can be really hard to figure out sometimes for companies. But yeah, I think it can work for some companies, and maybe is the best strategy for some companies, depending on who their customer is.
Got it. And I was interested to know, how did you start with Forum Ventures? You've also rebranded your company. How did that happen, and what's the thesis like?
Yeah, so So I had worked in two different startups for about 6 years. I was doing a little bit of angel investing, and I was I was helping some early stage companies on go-to-market. And I got kind of fixated on this idea that there were all these generalist accelerators like YC and Techstars and 500 Startups, but there were only a few in the country focused on B2B SaaS at the time. And I had built a good network of kind of early executives from that first wave of SaaS companies in the Bay Area, a lot of like early Box, early Salesforce, early Marqeta, Zuora, companies like that. And so I thought to myself, like, okay, if I could get a critical mass of really good kind of SaaS executives, and then I kept the cohort sizes really small so we could be kind of an extension of the founding team and like be really hands-on around go-to-market and helping to get kind of early sales, early distribution, and then help with fundraising. Like, could we build a differentiated accelerator over time? And so I went and started socializing the idea with my network. It was also, one of those things where I came from a very entrepreneurial family. I was interviewing for venture jobs. Like, it's really hard to break into venture even now, and there were a lot less funds then. And so I just realized like it was going to be really hard to break in. It's difficult to kind of differentiate. The timing has to line up. Like, there's just a lot of things that go into it. And so I thought to myself, like, what if I just like, maybe I can just create my own, even though I had very little investing track record and probably frankly had no business raising a fund. I decided to go for it. I started socializing with people in my network, ended up getting really great people who were like willing to kind of take a bet on me, even though I didn't have that track record. And more importantly, like put in their time to help get it launched. So people like Nick Mehta from Gainsight, CEO of Gainsight, like Karen Page, who was my boss at Box, she was the seventh person there and there through the IPO. Rowan Trollope, who was an exec at Cisco at the time and the CEO of Five9, now CEO of another late stage private company. And then was able to kind of got them as the first three as the nucleus, and then was able to kind of build around them. And I told myself, if I can get to $1 million, I'm going to do a first close and put myself in business and like force myself to do it. And so ended up getting to $1 million, and it took probably 6 to 8 months to get to that. And I was kind of on the side to pay the bills, and then launched initially under the Acceleprise brand. Acceleprise was one of the accelerators that existed. They were in DC, but they were running it part-time. They were winding it down. So I ended up working with them, licensing the brand, but created a completely separate management company, GP, LP, everything. And then, fast forward now 9 years. We rebranded about 2 years ago from Acceleprise to Forum Ventures. We're on our 4th accelerator fund, 2nd seed fund, which we added about 3 years ago. And then we also have a venture studio, and we're 27 people full-time, kind of spread out across Canada and the US.
Interesting. And, you've been able to raise, around $30 million fund. And how was the experience, raising the fund? And, especially for emerging managers who are listening to the call, what lessons would you have for them to raise the fund?
Yeah. So we've raised a bunch of different funds. So I mentioned we're on our 4th accelerator fund. The first couple accelerator funds, were a grind. The first one I raised like $3.5 million for. I told you I did $1 million. Initially, it took me almost a year to go from $1 million to 3.5. And it was a mix of like, finding those early believers and then like leveraging their networks to get intros into other LPs. And at that time, it was mostly like high net worth individuals. I got one downstream fund. And then I got kind of fortunate with like, I happened to get connected to someone who like had a whole thesis around investing in accelerators. And so there was just really good alignment there. And now we're kind of lucky in that the accelerator funds have performed really well. And now we have like kind of anchor LPs who just keep funding, that were in that first fund too, that have scaled up and keep funding kind of the accelerator. So I don't have to spend a lot of time fundraising for the accelerator now. They're kind of pre-filled before we even launch the next fund. And we raise a new one every couple of years. And then on the seed fund, we went back to scratch of like, okay, now we got to raise again. And oh, by the way, like we have to raise during all these like macro kind of craziness. Like the first one was, mid fundraise, COVID happened, and then there was a lot of uncertainty in the market. And now raising in this market is maybe the hardest I've seen since I started fundraising. But I think, the advice I would have is like, you're going to get a lot of no's. And I think what I did early on was spend a lot of time trying to like iterate on the narrative and convince people who are lukewarm on it that they should buy into the strategy. And I think frankly, like getting someone turned around who initially is like leaning out for some reason is really hard to do, like almost impossible. And so I think spending more of my time on the believers, like the people who have the first meeting and like they just get it and they are aligned with your strategy and they're leaning in, and like really spending time on that instead. And then I think the other thing would be just, really try to build top of funnel as much as possible. Like a lot of family offices are hard to find, and it requires a lot of like networking and asking people for intros and just being very deliberate around that. And I think it's helpful. And then also I've joined a couple emerging manager communities. So I've joined like Cool Water Capital. There's also the Emerging Manager Circle that the folks at Equal Ventures run, and there's a bunch of other things like Cool Water. But I think joining those has been really helpful. And then what ends up happening is you like kind of build relationships with some of the other GPs who are maybe not necessarily competitive with your strategy, and then helping to share introductions to potential LPs and stuff has been really helpful for building top of funnel. So those are some of the learnings I've had over the years and all the fundraising I've done it's been a decent amount. I feel like I've been fundraising constantly for 9 years. So.
Yeah, totally get that. And you look at investing into close to around 75 companies per year, and what are some of the qualities and characteristics that you look for founders and the companies that you choose to invest in?
Yeah, and that's actually ramped up a little bit. So we'll probably end up doing about 100 to 110 companies this year through the Studio, Accelerator, and Seed Fund. But yeah, characteristics we look for, a lot of it is just we look for kind of founder market fit. Like, why are you building what you're building? Like, what unique insight do you have? And then I think when we dig a little bit deeper, it's like, okay, would we work for or work with this founder? Like, do we think they're going to be really good at recruiting, and what goes into that? So how clearly and concisely can you kind of explain how your market's evolving and where you fit into that evolving market and how you win in that market, and can you confidently and clearly talk about like why you win deals against competitors and why you might lose deals today and how you'll fix that over time. Like, the more concisely you can talk about the nuances of your market, the more you'll build credibility around your ability to navigate that market. And even if people don't always agree with like how you think the market's going to evolve, if you have conviction around it and can kind of show data points around why you think you're going to be right and why you have early signs of your business working, like that's really powerful, because investors don't know as much as you do as a founder about your market in most cases. And so a lot of it is they're relying on your ability to explain to them how that's going to evolve. And I think the more clearly you can do that, the more excited they get about the idea that you'll be able to get other people excited about your vision, which means like better at recruiting, better at raising capital, all of those things. So a lot of it is that we obviously look at like market and market dynamics ourselves too, but we're trying to evaluate founders. And then the other is just like, are you obsessed with the business? And that's hard to tell. But there are certain things that we look for, like, if we ask you like, who's the biggest customer in your pipeline, and you don't know it off the top of your head, like that's a little bit of a yellow flag of like, you should be obsessing with like your business and how you grow your business and understanding who your customers are. So we look for things like that, like signs of kind of, are you like really obsessed with this business and building it into a big business?
Very interesting. And you mentioned about investing into 100 companies. So what's the ticket size that you look at? And also do you look at following up with the following?
Yeah. So we have 3 different ways we engage with founders. The way we think about it, we're building this like platform and community and set of funds that we want to engage with. We want to be like the top fund in the world eventually for B2B SaaS companies from what we call 0 to sustainable, and really like -1 to 0, and then sustainable. So we view sustainable as like Series A or self-sustaining, and that's kind of the seed fund is from like accelerator to Series A, and then we have the accelerator, which I view as like the 0 to 1 phase, and then kind of the studio, which is like the -1 to 0 phase. And so we'll do about 80 to 90 companies through the accelerator, which we write 100K checks initially. We're usually the first check-in or very early check-in. It's a pretty standard accelerator deal. And then we're like work as like an extension of the founding team. As I mentioned, we have a big team. We're 27 people full time, and we're like very hands-on on meeting with the companies weekly and all the programming and all the things you would expect from an accelerator and beyond, I think. And then the studio will end up starting probably about 8 companies this year through the studio, where we're starting companies from scratch. We usually come up with ideas either on our own or with kind of corporate partners. We validate those, line customers up, and then pull a CEO in to be the co-founder with us and run the company. And so as a CEO, you're coming into a validated idea with a team to build the MVP and money on the balance sheet from day zero. So it's a bit of a de-risked way to kind of start a company. And then the third is out of our seed fund. So our seed fund, we'll do about probably 12-ish companies, or 12 or so, 12 to 15 investments per year out of the seed fund. About half of those deals come from our own studio and accelerator, where we're following on, about half outside of it. And out of the seed fund, we're writing probably on average about 500K-600K checks.
Oh, interesting. Got it. And you're invested into Bboard, which had an acquisition to DoorDash, and how do you get to meet Steve Simoni, and how did you get the chance to lead around there?
Yeah, this is the beauty of this model. So we met Steve when he was the founder. He was the founder and CTO of another company that went through our accelerator that didn't end up working, but we built a great relationship with him. And so when he started Bbot. It was initially a hardware business, so we weren't investing. It was outside the scope of what we were doing. And then when he pivoted to SaaS, he called me and he was like, "Hey, we're pivoting to SaaS. We've got great early traction. Kraft is leading the round. We've got room for like one more VC. Do you want to come in?" And so we ended up talking to him and decided to invest. And so we were the only other fund in the round alongside Kraft who led it in the seed round. And that was because we had the relationship that we had built over years through the accelerator. So even though he didn't come into the accelerator with a second business, we ended up getting allocation in the round because of the fact that we had the accelerator. And he went through it with his previous business. And he's just one of those people you want to, like, he's just very high motor, very smart, like, really, really good founder. And then, they ended up raising an A and then getting acquired by DoorDash.
Got it. And especially for founders, how can a founder get to know that when it's the right time to move upmarket into enterprise, and how does that change in the world of product-led growth?
Yeah, it's a good question. I think I think when it starts to make sense is if you are starting as product-led growth and kind of going bottoms up, when you start to have enough kind of features from like security and all the features you need to sell at market, and you're starting to get pull at market. So you have some people who are helping you to navigate internally to like the decision makers for an enterprise-wide deployment, is when you should probably start thinking about like, okay, should we start building a top-down enterprise sales motion around this and replicate what we're seeing that's happening organically across these first few, maybe 1, 2, 3 customers, where you've got enough of a groundswell in an organization that they're starting, and they like the product so much that they're starting to help navigate you to, the CIO or whoever's making those enterprise-wide decisions. Usually it starts as like you get a department on board, you get a department head to buy it, and then you start getting like more department heads. It's rare to go from like full product-led growth to enterprise-wide deployment in one sweep. But yeah, I think once you start to see early signs of that happening across some customers organically, I think you start to think about, and you have the feature set to support an enterprise-wide deployment, then I think you start to think about like, should you build a top-down sales motion around that?
Got it. And you've been part of partnerships team at Box. I was wondering, when is the right time to build out channel partners, and how do you see channel partners change the structure and resource allocation at a company?
Yeah, I think we were early at Box doing it. Like in hindsight, we've seen a lot of companies try to build out channel partnerships, and when they're too early, I think it's difficult. You rarely get out of it what you think you're going to get out of it, because I think the reality is like usually the channel partner is a much bigger company, and like they have a much lower incentive to resell your product than you have for them to resell it. And so I think you need to figure out like, one, you need to have enough mutual customers that there's like clear use cases and examples that they can point to. And then you need to figure out like, how do you actually build relationships with not just the company and the person running the partnerships, but like the actual people who are going to be distributing it for you, like the salespeople or whoever that's going to upsell this product. And if you're not building real relationships with them and telling them how to sell it and how to talk about it and why it's going to help them get, accomplish whatever goals they have, which is probably like, hitting their KPIs or getting commission or whatever, then it's going to be hard. You're not going to get as many, as much distribution through it as you think. And so I think you have to be pretty thoughtful around it. You have to have mutual customers with that channel partner already. And I think you need to really think about what's the strategy to get whoever is going to be the end deliverer of your product to the customer. Like, how do you get them engaged? Why do they care? And like, how do you incent them to care so that they actually distribute it? Because so many times people are like, oh, I got some big company to distribute my product and we got this big partnership and they're going to make an announcement. Their marketing team's going to make an announcement and we're going to get flooded with leads. And it like rarely ever happens like that. So I think you just need to be much more thoughtful about it.
Got it, interesting. And I want to understand, I mean, it's been a couple of weeks now, but what really happened with, Silicon Valley Bank, and did you get to see, will you get to see a lot of great, LP churn and, eleving the asset class after what has happened with Silicon Valley Bank?
That's an interesting question. I don't know if it'll create LP churn in of itself. Will the macro environment create LP churn? Like, certainly it feels like a lot of institutional LPs are not either kind of waiting and seeing, not really adding new managers. Like they're a little bit more risk averse in the sense that like there's like a little in my experience, which may not be true and may not play out. I don't know what the data says, but like anecdotally, it feels like there's a little bit of like a flight to safety where institutional LPs are like, you know what, we're going to go back to like putting money in with the big brand name funds because it's safe. And like, if it's a fund of funds, like their LP is like that. If it's an endowment fund, their board likes that. Like if it's a foundation, the board likes it. So they all kind of answer to someone. And, it feels, it's like the old adage of like, you don't get fired for buying IBM. Like, I think there's a little bit of that flight to safety, which means people are more risk averse, less likely to invest in emerging managers. Because it's in their mind, it's probably harder to pick, even though there's a lot of data around the fact that there's like more alpha to be had with the small emerging managers. It's just harder to pick which one is which. So anyway, it feels like there's some pullback from LPs. I don't think it's solely based on what happened with SVB. I think that was probably a little bit of, it was definitely a shock to the system, but it wasn't the only factor in my opinion. And yeah, that weekend was certainly stressful. Like we had a lot of companies who had money in SVB. We had gotten our money out of SVB, but yeah, I mean, it was a stressful weekend for a lot of people. And what's been interesting is like, who's going to fill the void that they had? Because we as a fund, like I've been trying to get our fund accounts open with all the big banks, and like they don't want smaller funds, right? Like you have to have a certain amount of AUM to bank on the fund side. And so that's been challenging to like, you have on one side, big LPs who want the money in a big bank account, but the big banks don't want your fund account. So a lot of emerging managers are kind of stuck in this, like, they have to use a different bank that maybe some LPs view as a little bit riskier. But it's been an interesting few weeks or month, however long it was, but it's been interesting.
Yeah, no, absolutely. And I was wondering, what advice would you give to your founders? Would you still advise them to, work with the, smaller banks like Mercury and Brex and others, or would you still advise them to work with, bigger, more established banks of what has happened with SVB?
Yeah, I mean, it's funny, in a zero interest rate environment and before all of this happened, like no one thought about who they banked with. It wasn't even a thing. And now I think what we're advising is just that companies need to be more thoughtful around treasury management, right? Like they need to be probably more diversified. They should probably have some money with a big bank. They should have some that's like more accessible and better UI with a Brex or a Mercury. They should think about like, okay, if you've got cash sitting in your account, like how do you earn yield on that, and where's the best place to do that? So I think what we're advising is just a more thoughtful approach to treasury management in this new world. And that's probably a more diversification of where your money is.
Correct. And especially when it comes to investors, what are the single biggest mistakes investors make when they analyze competition?
When they analyze competition,
Yeah.
yeah, I think part of it is just you don't want to over-index on competition. So there's two ways people look at it, of like, if you see competition that's early, but there's a lot of them, like, is that validation, or is that the market's too crowded and you can't win? And so I think a lot of that is like figuring out the market dynamics of why would this company win over the other companies that are funded, and like, is it a winner take all dynamics or not? And if it's not, how big is the market? Can it support 3, 4, or 5 really big companies? So that's part of it. And then there's always the like, well, what if this big company builds it? Thing that VCs ask and founders hate. But I think that's something that, again, there's nuance to all of this, but like, it comes down to what is the product you're building? How foundational is it to the big company? And do have they had a history of like building new products internally? I think the more likely scenario is a lot of big enterprises will acquire. And then you look at like, okay, if they are going to acquire an early winner or the second place company in this space, like, is that going to be a big enough outcome depending on where you're investing and the entry price you're getting in at? So I think you got to look at all of that stuff, but it's hard to say one size fits all here.
Got it. And what are the biggest mistakes founders make when they're presenting the total addressable market, and how it breaks down to investors?
Yeah, I see it. I mean, we see a lot of depth, and I think a lot of founders take a relatively unthoughtful approach to it and take like a top down, like, the total spend on this very high level category of software is X, and that's the size of our market. And I think a much better way to do it, and a much more nuanced and thoughtful way to do it, is to take a bottoms up approach of like, here's how many customers of the types, here's our ICP, or what do we think our ICPs are going to be, our ideal customer profiles. And here's how many of them there are. And here's how much we think we can charge today, or, eventually. And here's, if it's, smaller today than it is eventually, then like a thoughtful kind of narrative around like how you get from X to Y over time. And then what's the addressable market based on that? Because that's a much more realistic version of like what your revenue opportunity is and what the market opportunity is. And I think too many founders just take this like very generic, like the CRM market is X and we play in the CRM market. And it's not indicative of like what is the actual market opportunity. So I think that's one mistake we see a lot of founders make.
Got it. And with the new seed fund, I think more than 50% of all the investments have had a woman or otherwise underrepresented founder, but we still see that I would say around 3% of all the VC money goes into women founders. What can be done to improve the probability for women founders to raise more VC money?
Yeah, it's a good question. I don't have all the answers. I think what we've done, I can tell you what we've done internally, and I think we can still have a lot of room for improvement. But we've been very intentional about building a very diverse team, and so I think we're probably more than half women on the team out of 27, and have a lot of diversity within the team, and then we track and set KPIs around diversity within the portfolio. And we kind of view it as like, we invest even though we're a relatively small fund, we invest in a high volume of companies at a very early stage. And so we think, relative to our size of fund, like we can have an outsized impact, because we then also like have sessions within the accelerator around the importance of building diverse teams, and how making your first few hires diverse hires can kind of set the tone and the culture for the company long term. And so we think we can have like an outsized impact on that at the portfolio company level. What funds should be doing to, and the ecosystem at large should be doing to increase that is, hard to say. I don't have all the answers, but I'm focused on what is the impact we can have within our portfolio company and within the investments we make and on our own team. And hopefully we can make a tiny dent in that terrible number, but it's going to take a lot more than just this one small fund doing that. And hopefully, there are a lot of funds kind of focused on that, and hopefully over time we see better numbers around that. But I don't have all the answers.
Yeah. Okay. Got it. And Michael, you've been in the VC industry for quite a long time, and we have seen waves of crowdfunding and angel syndicates with ICOs. But now, how do you see the venture capital landscape, changing in the next 5 to 10 years? Do you think, you did mention earlier that it's difficult to break into the VC, circle, but how do you see any change coming in the next couple of years?
So it certainly ebbs and flows with the market. Like I would say, in this market, there are a lot less like angel investors deploying capital. I think and angelists would have all this data, but just anecdotally, it seems like there's less like rolling funds and syndicates that are deploying capital and actively at like pre-seed and seed at least. And there were thousands of new funds that came up that got started in 2020 and 2021, and I think a lot of those are going to struggle to raise a second fund in this new environment, and some of them will wait it out, and when the market gets better, they'll be able to raise it. Some will be able to raise a second fund, and some won't. And so I think you'll get a decline in the number of small funds short term here, and then the question will be how long does that persist, and will we eventually see a rebound with more and more funds? And I think that will partially come down to do you see a swing in LP dollars, right? Do LPs get, over time get more of an appetite for emerging managers and smaller funds? And there's a lot of data that says smaller funds outperform bigger funds, but there's a lot of risk that goes into that, because it's harder to decipher who's going to be the winners. And if you're a big endowment and have billions of dollars to deploy, it's a lot more work to deploy a bunch of $5 to $10 million checks than it is to deploy $100 million check. So there's a lot of reasons why that may not happen, but my hope is that shift starts to happen, which will then create a rise of more emerging manager funds again, and hopefully a more diverse set of emerging manager funds. But I tend to think I also think a lot of the big funds are going to right size a bit. Everyone kind of got it was an AUM game in 2020 and 2021, and they raised tons of money. And I think you'll see a lot of the bigger funds kind of right size back down to fund sizes that make more sense given the new reality of the world, where $10 billion outcomes aren't the norm anymore. I tend to think, at least in the SaaS world, multiples are going to normalize back to what they were in 2017, 2018, and we'll never see 2020, 2021 multiples again, at least not for a very long time. And if that's the case, getting to $10 billion outcome is really hard. Even getting to $1 billion is really hard, right? And so if you have a $5 billion fund, the math is really hard to return that. And so I think you'll start to see some of that peter out. And if they're right sizing their funds and coming down, that money is probably going to go somewhere. So maybe it gives some hope for emerging managers, but we'll see.
Got it. And I quickly want to do the top 3. What's your favorite business book?
Yeah, I have a bunch. I always think the Good to Great from Jim Collins is good, and 0 to 1 from Peter Thiel is a good one, and How to Win Friends is a good one. There's a bunch, but those are some of the ones that I would name.
Got it. We'll put that in the show notes. And if you could go back in time when you started Forum Ventures, what is one thing you would have focused on or done things differently?
Yeah, so I am, in general, my personality is not an outward facing big personality and on Twitter and marketing, and I don't have much of like a brand marketing background. And so I think I wildly underinvested in brand for a long time, and instead was like, you know what, I'm going to focus on what I think I can be good at, which is like be maniacally focused on founder experience. And if we have enough founders that go through the program who have like an amazing experience, like we'll organically build the brand over time. And I think that's right. It just took a lot longer than I thought it would. and I way underinvested in building the brand and marketing. And so now over the last couple of years, we rebranded and we've been a lot more focused on building that, which has yielded just, you know, a continual growth of inbound for like applications for the accelerator and sourcing and everything. So yeah, that's something that like I wish I probably invested in more early on.
Correct. And do you have any favorite online tool, for example, Gmail, Slack, Zoom?
I mean, I'm in email so much, you know, Gmail, but that's a basic one. I'm a tiny angel investor in a company called Hyperwrite. So I've been playing around with some of their products recently within Gmail around like helping you just get faster and more efficient within email. So that's been good. And then obviously we're on Slack all the time with both our founders and internal team. But.
Correct. We'll put that in the show notes. Michael, what is the best way people can reach out to you and know more about Forum Ventures?
Yeah, you can pitch us on our website. You can email me at Mike at Forum VC. I'm on Twitter at MG Cardamone. Any of those are fine.
Correct. We'll put that in the show notes. Michael, thank you so much for taking our time speaking to us. I really enjoyed my conversation with you.
Yeah, of course. Thanks for having me. I appreciate it.